Natalie Martin.
Yes.
You wear a range of different hats at Folio.
hmm
Talk to me about what you do at Folio.
So I sit in two divisions. So I sit in the advisory space where I speak to clients, bring them on board, take them through a portfolio planning session to get them to understand where their portfolio needs to go to. And then I also buy for clients. So I sit in the buyer's agent side as well, just with a lot of my experience that I do have with previous roles and jobs that I've had, that I can still acquire properties for clients where I need to.
Yep. Not only that as well, you're a senior member in the team, so
Yes.
mentoring is key, especially with a lot of the new buyers agents that we get into the business. What's some of the key things that, from a mentoring side that you focus on with some of these guys?
So I've had almost 16 years in the game, which has allowed me to have a lot of experience throughout buying. I've bought across the country in a previous role that I've done. So I have a lot of information that I can pass down. What I like to do is the fundamentals, what we look at, why we look at them, making sure that the properties are going to fit for a client and that they're going to fit for long-term purpose, investment, owner-occupier, subdivision, and a whole host of different things.
Yeah.
So taking them through the fundamentals before we start with anything else is really important to me.
Yeah. You mentioned 15 or 16 years?
16.
16 years? Sold you short there. 16 years in the property industry.
Yep.
So why property?
I've always loved it. My parents bought a couple of investment properties when I was younger, and I loved watching them do that. They made good money on them. And I almost fell into property as a career. So I started my degree qualifications in radiology and x-rays. And then I decided I really didn't like that path anymore. It's very intensive and a lot of cadavers and bits and pieces.
Yep.
So at the end of the year, I had teaching, nursing, or property like business commerce to go into from Curtin. And I knew I didn't want to be a teacher. I knew I didn't want to be a nurse because it's basically the same things I was doing for radiology. So that left me business. My mum is an accountant by trade. My dad was an accountant by trade as well. And I knew that was not for me. I loved more the economics and finance side of it. And so they had the course in property and valuations. And I went, okay, let's transfer into that, give it a turn, and never looked back.
Yeah.
Yeah.
That's awesome. And what about from a client perspective, maybe looking at more from the advice side? So, from a buyer's agent's side, you're servicing all clients. What about from an advice side of things? What's the typical client that you deal with from a day-to-day basis?
So typical clients we get a lot of first-time investors that want to start to build their portfolio out. So it's really crucial that we buy the right asset for them to start with. You want something that's giving a good return, not just capital growth, because we want to build a portfolio out for them. If they're a client with a few properties under their belt, then we can look at a more advanced type of acquisition for them or type of strategy. But the clients that are sort of coming to us tend to be sort of first-time investors, really wanting to look into that. So we want to make sure that we give them something that's got a good yield and going to perform well for them so that their servicing stays high and they're able to get additional loans, and we can look to build out a portfolio in the next 3 to 5 years with a few properties under their belt.
What about due diligence? Like, how important is that when selecting the right asset type? I mean, you've got the experience where you can be dealing with a client from the very start, from an advice standpoint, all the way to purchasing that asset. How key is due diligence in that whole process, especially from the buying side of things?
Absolutely crucial. So you really need to have the due diligence done. We want to make sure that there's no housing commission nearby. They're salt and pepper through every suburb. Even in Perth, they're in Claremont, they're in Subiaco, they're in very affluent suburbs as well. You also want to make sure that the fundamentals are there for the property. So if it's something that can be developed, making sure that there's no easements that could prevent anything like that. Without a strong due diligence, you could end up buying the wrong asset and it can be compromised and you wouldn't even know it. And then that results in you may not get the growth that you thought you could, or if you hold it too long and we don't sell it prior to the peak of a cycle, then you're going to get less for it moving forward in that downturn period.
What about speculative assets? So we talk a lot as a business about speculative assets being your house and land package areas, your high-rise off-the-plan apartments, your risky regional plays like your North Queenslands or your Darwins to a certain extent. What's your opinion on speculative assets, and is speculative assets a right move for someone in their portfolio?
It can be a right move if it's done when you've already got a strong portfolio. Then you are able to take more risks and move into that speculative assets. I've seen where they have gone horribly wrong for people, especially in the mining towns in Perth. So that Karratha was a perfect example. At my previous role, I worked for Defence Housing. We sold properties in Karratha for around about $1 million to clients. They were getting $3,500 a week rent from DHA, and a lot of them still ended up in mortgagee in possession. And the downturn came, and Defence was no longer paying DHA the rent that DHA was forking out either. So it was a really bad asset all rolled into one. So they can go very, very wrong. So you have to be in a cash flow strong position. You've got to have good servicing available. And then regional markets can be a little bit trickier. They ride really hard in an upswing, but they also crash really significantly in a downturn. So if you're not paying attention week by week, month by month, you may miss the boat and it can cause a lot of pain. And then you've got to hold it for the next cycle, and you may not want to hold it for that long. And the next cycle could be 10 years away. So, yeah.
I think that's a really good answer because although, we're pretty passionate about only investing in blue chip assets, we very much, if someone comes in with speculative assets in their portfolio, if it is under, say, a 20-30% buffer that we determine, we don't necessarily recommend them to sell. They just need to be in a position where they're comfortable that they know that is a risky asset.
Yes. Yep, definitely.
What about from a capital growth and cash flow perspective? You deal with a lot of first-time investors, and they're, especially on the front end, we get a lot of clients that will come to us and they want this unicorn asset that's going to have yield well and have strong capital growth. I've heard arguments on either side from a first-time investor. What's more important, capital growth or cash flow? From your experience, I know this isn't going to be tailored to every individual, but what do you think is most important for a first-time investor to be focusing on?
Cash flow. Because usually a first-time investor wants to buy more than one. And the only way to buy more than one is to keep your servicing at the levels we need to keep it at. So you need a minimally negatively geared asset. Nothing at the moment is positively geared or neutrally geared when you encompass all of the costs and running costs of an asset. So you really need to make sure that cash flow is strong. So cash flow is definitely, and yields are definitely more important. If we're buying in the correct areas and we're doing the due diligence and we're doing everything else, that capital growth will always sit there.
In 2026, where do you see the best investment opportunities in Australia?
Melbourne, right now. It will have a little bit less growth than Perth will. So Perth will probably have 15 to 20% growth just in the nature of what's occurring at the moment. There is now talk from the RBA that interest rates are going to go up 2026, which will restrict a few things. But Melbourne is where Perth was 3 to 5 years ago. Melbourne really is the play at the moment, and that's where you're going to get the growth that you're going to have and what you want to do.
And both of us have gone over to Melbourne regularly with the business to go look at the assets that we're buying and meet with the team on the ground there. And it's crazy to see the types of assets and the price points you can get in Melbourne versus an area like Perth. And there's some clear value there, but I think people aren't seeing it just yet because it's at the start of its cycle.
Yes. And our market in Perth is moving $10,000 to $20,000 a week. So someone will pay $700 for a property. The next week, that's $710, $715. In Melbourne right now, it's a little bit quieter on the buying front. There's still a lot of active buyers in the market, but you're not having to outbid as aggressively as you are in Perth. So there's more money to be made in that side of it. You get a bigger asset. So now your 650 budget in Perth really is a villa type asset or a strated asset. In Melbourne, we can still get you a 3x2 on sort of 500-600 square meters of land. You can't get that at the moment for that price in Perth.
Yeah. Very much feels like Melbourne is that medium to long term play, whereas Perth's going to have will outperform, as you said, in the next 12, 18 months.
Yeah.
What would be your biggest piece of advice for either a first time investor or someone looking to build on their portfolio?
First time investor is really do your research, have a look at the market, see what they're doing so that you can understand the fundamentals. Find someone that aligns with you and a company that aligns with you to build out that portfolio. Don't try and do it yourself because you may fluke the first win, but you won't fluke them all. And if you buy the wrong asset, it's going to be very detrimental to you long term, and you may have to hold an asset and prevent portfolio growth. For a seasoned investor, it's time to upscale. So don't just keep buying the same residential properties that build your capital growth over a slower period of time. Look for something that you can develop because you've got the other ones in your portfolio looking after the fundamentals. So be a little bit more adventurous, be a little bit more bullish in certain assets in the right market.
Yeah, that's interesting. So, in your advising role, you do portfolio reviews with your clients. So, some of those clients that maybe have experienced a lot of growth in some of these C or D grade assets, maybe it's a time to start looking at some of these blue chip assets as well for the next stage.
Yes, divest your C and D grade assets. Even if they're in Perth, you may miss out on 12 to 18 months growth, but you've had great growth from when you've purchased it. Take that and get a blue chip asset somewhere else, whether that be Perth, whether that be Melbourne, and then use that blue chip asset to further your portfolio.